Well, it is true that we are seeing these technology stocks trade at a premium relative to their historical price to earnings. But I think at this juncture, if we look historically, when PEs were similarly as elevated, we didn't have the profitability of some of these companies. Whereas clearly we are seeing these tech companies, most notably the Magnificent Seven, continue to churn out quite robust earnings that are far exceeding analyst expectations. If we look in the second quarter earnings, they came in about close to 30% year on year, and that was well above, more than, I think about double what analysts had expected. So they're clearly showing their profitability in this backdrop where AI demand is far outstripping supply. But to your other point, yes, we are seeing billions being deployed on capital expenditure in the space, and it's not clear to investors whether we will see a meaningful return on this investment. But I think at this juncture, we are expecting to see some gains on the back of these that does warrant investors paying up and paying a premium to get into these stocks, because AI is really going to be the trend that's going to be persistent for quite some time. And I think at this time period of time, we are seeing those key tech companies really benefiting from that first mover advantage in the space. And so it's going to be quite challenging for disruptors to enter the space and take that power away. So I think at this point, we're still leaning into that and being quite overweight US large caps. That's an excellent question. We do think if we do see a disruptor to the market, it's likely going to come from China. We saw that clearly earlier this year with DeepSeek come through. I think we still hold that US large cap overweight, but then we've been playing kind of that China tech space much more tactically. I think we would need to see more robust signs of a broadening in the Chinese economy in particular for us to have more conviction overall in the space. But again, I think we are going to see winners and losers across both the US and China tech space. And I think that does warrant a much more active management approach to the stock selection, because you don't necessarily want to take these broad benchmark exposures when there are going to be these idiosyncratic stories emerge like we saw earlier this year. I mean, if we look at the US, we are still finding some opportunities. I mean, we've seen small caps really outperform over more recently. I mean, we're not as strong of conviction in terms of the small cap space as we are the large cap, but we are seeing this broadening out. If the US does avoid a recession, the Fed continues to cut rates, perhaps then there are those value pockets in the market that are going to benefit as well. We do like more of the defensive sectors. I think it's about taking a barbell approach to the US equity market in particular. So on the one hand, having those kind of expensive tech stocks, but then balancing that out with more defensive positions. So dividend growers and infrastructure are kind of the two key ballasts of support in a portfolio that should provide more resilience amid likely further volatility. I think at this juncture, we are going to continue to be in a period of volatility, and this is marked by ongoing tariff uncertainty, geopolitical uncertainty, policy uncertainty that's emanating from the US. So I think it's really about being quite potentially defensive, but as well, I think diversification is really important across equities, whether that's the US or globally. And as well, we really are in a golden age of fixed income because of where yields are. And so I think this is a very attractive environment for investors to get those elevated yields with a relative degree of safety in fixed income. So I think it's, despite all of the uncertainty that's happening in the world, I think this is quite an ample opportunity set for investors to take advantage of. Price pressures in the US are going to climb in the next few months. And that's because up to now, we have seen, corporates more hesitant to pass through those prices. There was this degree of uncertainty, but a lot of those tariff pauses ended in August. So we think that corporates are now going to adjust their prices accordingly. And if we look at the US, we think core PCE inflation could actually climb to a peak of 3.2% this year. I think the key takeaway from the September FOMC meeting was that the Fed is acknowledging that the balance of risks have shifted. So previously they were, largely focused on the inflation side of their dual mandate, but because we're seeing some deterioration in the labor market, that they thought, well, they're going to take a closer look in terms of the employment backdrop. But they made it quite clear that they are going to be data dependent. So markets initially did focus on that dot plot, which did signal 2 more cuts by the end of this year. But if we still see fairly resilient economic backdrop, if the payrolls numbers next month come in quite strong, and at the same time we see those inflationary pressures build, that's going to be a very hard backdrop for the Fed to cut at both meetings. So to our mind, we do think they're going to cut once more this year, likely in December because of those inflationary pressures more near term, and then potentially cut another 2 times next year. So for a total of 3 cuts over the next 12 months. But again, this is highly predicated on the incoming data, particularly looking at the labor market if we do see these inflation pressures start to subside. That's the key question. Are we going to see a recession come through in the US? At this juncture, we assign a fairly low probability, about 35 to 40%. We're clearly not seeing it come through in the data. If anything, the Q2 GDP revisions, to your point, came in exceptionally strong, and this was entirely driven by the strength of the consumer. Now, we are going to wait details in the monthly composition for whether this momentum can extend, but I think this just adds to the point that the Fed may struggle to cut consecutive meetings if the backdrop continues to be one of economic resilience and inflationary pressure. So perhaps markets are getting a little bit ahead of themselves in anticipating that this could be an aggressive easing cycle going forward. And then from a kind of a markets perspective, I think the Fed cutting rates even at a gradual pace with a supportive economic backdrop does still portend kind of broader support for risk sentiment and equities overall. So I think to your point, the global bond market has seen this significant curve steepening on the back of what we are seeing come through from the fiscal side. This is most pronounced in the UK, I would say, and even in Japan. I think when it comes to Europe, we are kind of seeing this additional issue of the German fiscal stimulus coming through. So that is going to prop up economic growth, but it's also going to come with greater issuance in the bond market. And it's one of the reasons why we think that the German Bund yield can climb well above 3% over the next few years. And so it's really that dynamic that's driving Germany. I would say elsewhere in the UK, it's really been more of a fiscal story. But again, we think markets are kind of pricing in or anticipating another fiscal crisis because it's clear the government needs to have a material degree of fiscal consolidation to have debt sustainability. But we think they are going to come through with sufficient tax hikes. And at the back against that, we think that growth will come under greater pressure, and that will prompt a much more material Bank of England rate cutting cycle. And so that should actually bring the long end yields quite a bit lower in the UK. Yeah.
Yeah.
It's a great question. I think what we're going to see is that a country like Germany is going to do a lot of the heavy lifting in pledging to increase their defense expenditure as a share of their economy, whereas other countries like the periphery perhaps aren't going to be as meaningful of a contributor to the defense spending backdrop. But again, this is all about how this expenditure translates into growth. If we do see that this spending has, a material multiplier that suggests that growth is going to be bolstered, then debt as a share of the economy is actually going to maybe trend fairly sideways or slightly higher, rather than a material uplift in that front if we don't see the growth backdrop supported. So it's all about the denominator as well, even when you are spending even more. So I think fiscal sustainability, at the margin, it could become a concern if we see growth deteriorate, but I think at this backdrop, really the spending is going to be quite positive as a growth impulse for the region overall. I think to your point, US investment grade credit is trading very rich. We look at the spreads is in the IG space is trading, close to record lows. But then at the same time, we are seeing all-in yields remain quite attractive. So these yield-hungry buyers are still looking for that US corporate credit exposure, particularly when fundamentals remain quite strong. We have healthy cash flows, we have strong balance sheets, the technicals remain supported as well. So overall, we do still remain quite constructive on credit, but I think it's important as well to look at a diversification across the credit space, whether that's in terms of sectors or different types of credit. So securitized credit is one area of opportunity because you can get higher yields and really take advantage of the dispersion that's emerging across the space.
Um,
Yeah, exactly. And I think it's all about the attractive yield backdrop. So even though the Fed is cutting rates, we don't expect the Fed will need to go back to kind of the historically low or zero lower bound where rates were over the past decade or so. So this is still going to be a structurally higher interest rate environment, in part because of the inflationary pressures that we do see come through. So against that backdrop, then yes, senior loans is still quite an appealing area of opportunity, particularly for foreign investors looking for those US dollar denominated assets. I mean, we still like the AI sector as the long-term theme. So investing in data centers, investing in kind of those companies that are going to benefit most from the digitization of the world that we are seeing come through. I think ultimately we are taking a very defensive approach in terms of credit. We want to kind of stay away from more of those cyclical leaning sectors because, we could see potentially the labor market come under pressure. Maybe the US economy is not as healthy beneath the surface as some of the indicators suggest. So again, just taking a very defensive posture rather than taking on some of the cyclical exposures.
mm,
So we've been overweight in financials in both Europe and the US, and this is
mhm.
largely based on the fact, to your point in the US, that we are going to see this deregulatory environment come through, maybe even more materially next year, and that should act as a further tailwind to the sector. And then in Europe in particular, we are seeing financials be quite attractive. We think at this juncture, the European Central Bank has actually finished their rate cutting cycle. So yields are going to be supported as well in this backdrop. So again, a very supportive backdrop for financials. And that clearly played out in Q2 earnings as well, where financials were really continued to be resilient.